Today, who blinks first? The DFA Daily to the 9th of September 2021. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and problem news with a distinctively Australian flavour. Today we look at the action on the US markets and also specifically look at what the SEC is doing with regard to cryptos and how that may change the trajectory of stablecoins ahead. Wall Street ended lower on Wednesday, spooked by worries that the Delta coronavirus variant could blunt the economy's recovery and uncertainty about when the Federal Reserve may pull back its accommodative policies. Apple and Facebook fell 1% after helping push the Nasdaq to record highs in a previous session. The dips in those two Silicon Valley giants contributed more than any other companies to the S&P 500's decline for the session. Investors have become more cautious following Friday's weak August payrolls data, while pressures from rising costs, despite the economy slowing, have increased concerns that the Fed could move sooner than expected to scale back massive monetary measures enacted last year to shield the economy from the coronavirus pandemic. The US economy downshifted slightly in August as concerns grew about how the renewed surge of coronavirus cases would affect the economic recovery, the Fed said on Wednesday in its latest Beige Book compendium of anecdotal reports about the economy. The S&P 500 has dipped less than 1% from its record closing high last Thursday, and it remains up 20% to date, buoyed by the Fed's accommodative monetary policy. Investors are pulling petals from a daisy, saying the economy will grow, the economy won't grow, said Sam Stovall, chief investment strategist at CFRA. They can't make up their minds, so they have no commitment to long-term positions. St. Louis Federal Reserve Bank President James Bullard told the Financial Times that the Fed should move forward with a plan to trim its pandemic stimulus programs despite a slowdown in jobs growth. 6 of the 11 S&P 500 sector indices fell, with materials and energy the deepest decliners, down over 1% each. The Dow Jones Industrial Average fell 0.2% to 35,031, while the S&P 500 lost 0.13% to 4,514, and the Nasdaq Composite dropped 0.57% to 15,286. Cryptocurrency exchange Coinbase fell 3.2% after the US securities regulator threatened to sue the firm if it goes ahead with plans to launch a crypto lending scheme. And US payments giant PayPal Holdings declined 2.7% after it said it would acquire Japanese buy now, pay later firm Payday in a $2.7 billion largely cash deal. Gold took a fresh hard tumble beneath the key $1,800 an ounce level on Wednesday, before settling in the red again for a fourth day in a row as a rebounding dollar capped a comeback by the yellow metal. Most active December gold futures on New York's COMEX closed down $5 or 0.3% to $1,793 an ounce. It has moved around from $1,783, its lowest since August 27th, after an intraday high of $1,804. On Tuesday, gold December lost $35 or 2% in its sharpest one-day slide in a month. Despite going somewhat down the same path as a day earlier, gold cut its losses on Wednesday after demand for the 10-year Treasury auction sent bond yields lower. John Williams, president of the New York Federal Reserve, also generated fresh hawkish pressure for stocks after he called for a taper as soon as possible of the central bank's 18-month long-term stimulus. Yet, gold couldn't capitalise on these elements to settle above $1,800. Gold needs both Wall Street to believe we have seen the high in Treasury yields for the year and for some institutional investors to lose confidence in cryptocurrencies, said Ed Moyer at New York's Onda. Bullion traders are hesitant to buy the dip right now and may wait to see signs from central banks that further stimulus is likely to address the recent deacceleration. So long as gold remains below $1,800, is at risk of falling to $1,750 or below, Moyer said. Gold remains in the danger zone as the dollar continues to rally on safe haven flows, he added. Gold's latest malaise came on the back of a dollar's rebound as the greenback put on a recovery after a 6-day battering that climaxed with Friday's US jobs report for August that came in almost 70% below target. Rightly, gold should have retained its mojo from last week, but yielded instead to the dollar, said Sunil Kumar, Dixit of SK Charting in Kolkata, India. Gold's path from here will depend on how DAX acts, he said, using the trading symbol for the dollar index, which pits the greenback against 6 other forex majors. Gold is currently trapped between $1,797 and $1,803. This $6 range will decide how gold will perform next, he added. If it continues going below 1797, it will likely be heading for 1770, but if it can sustain above 1797 and break beyond 1803, it can climb again to 1825. And elsewhere, US Securities and Exchange Commissioner Chair Gary Gensler just put the cryptocurrency industry on notice of how far the regulator will go to tame a market he's labelled the Wild West of finance. In threatening to sue Coinbase Global if the exchange lets customers earn interest on their digital tokens, the SEC sent a warning to other firms already offering similar products or contemplating so doing. The move is the clearest sign yet that, under Gensler, the regulator will aggressively use its powers to thwart products it's uncomfortable with even before they launch. Privately, ex-SEC officials said they were shocked by the agency's posture, which Coinbase disclosed on Tuesday in a blog post. The former officials said that the SEC typically waits for firms to start selling investments before announcing possible sanctions, indicating the agency has found a forceful way to shut down cutting-edge crypto offerings it fears are putting consumers at risk. Coinbase slid 3.2% to 258.20 in New York trading on the news of the SEC's pending enforcement action. The SEC is being aggressive for the first time in a long time, said James Cox, a professor at Duke University School of Law. The SEC has been putting a lot of muscle into cryptocurrency. It's a big, fast-growing market and a fertile area for abuses. SEC officials declined to comment. When Gensler took the reins at the SEC in April, many crypto enthusiasts cheered. That's because the former Goldman Sachs Group partner knew finance and had taught him a class on digital assets at the MIT, a background far different from most Washington officials who had a limited understanding of the booming market. But that optimism has all but faded after Gensler made clear in speeches and congressional testimony that a crackdown was looming. In July, he referred to the industry as the Wild West of our financial system that desperately needs rules of the road. And Gensler also said the SEC will step up efforts to hold firms accountable for offering products that may involve securities, including in decentralized financial or DeFi platforms. At issue is Coinbase's Lend product, which promises investors they can earn 4% annually by lending out their USDC virtual tokens. USDC, which is offered by a consortium of firms, including Coinbase, is a stable coin, a fast-growing corner of the crypto market that allows traders to easily convert their digital assets into cash and vice versa. Stablecoins have been the focus of intense scrutiny from top US officials this year, including Gensler and Treasury Secretary Janet Yellen. Watchdogs have raised numerous concerns, including that the tokens should probably be registered with regulators so that they adhere to strict investor protection rules. Officials are also worried about crypto firms promising high yields without complying with bank requirements such as deposit insurance. Coinbase's tussle with the SEC became public when Paul Grewal, the company's chief legal officer, said the SEC determined that Lend involved a security but wouldn't say who or how they'd reached that conclusion. Grewal added that the agency told Coinbase that if we launch Lend, they intend to sue, prompting the company to shelve the product until at least October. Coinbase Chief Executive Officer Brian Armstrong, later tweeted that the SEC was engaging in really sketchy behaviour. The crypto exchange won support from at least one long-time SEC adversary, billionaire entrepreneur Mark Cuban. In a series of tweets, he urged Coinbase to fight back to prevent the agency from winning a legal ruling that allows it to assert more authority over tokens and DeFi. Cuban famously prevailed against the SEC in 2013 after it accused him of insider trading. There are signs the SEC was already scrutinising Coinbase's plans. Last month, the company disclosed in a regulatory filing that it had received investigative subpoenas from the SEC and similar subpoenas and demand letters from various state regulators for documents and information about certain of our customer programs, operations and intended future products, including our stablecoin and yield-generating products. Despite Coinbase's bewilderment, the SEC has long argued that a range of tokens fall under its jurisdiction. Under the past 4 years, the SEC has consistently asserted that many digital assets are investment contracts or securities based on a legal theory known as the Howey test, laid out in a 1940s Supreme Court case. The regulator's stance is that almost anything that gives investors the expectation of profiting from the work of others can be labelled an investment contract. The industry has countered that the SEC's view is too vague and unsuitable for virtual coins, and the SEC's GOP commissioners, Hester Peirce and Elad Roisman, have routinely admonished the agency for relying on punishments to clamp down on tokens instead of writing clear rules for the fast-developing market. In a recent public statement, the Republicans said providing guidance piecemeal through enforcement actions is not the best way to move forward. The move is also likely to cause concern among companies like BlockFi and Gemini Trust and Celsius Network that already offer services that let clients earn interest for lending out their tokens. New Jersey is among states that have ordered BlockFi to stop marketing some products. Gemini declined to comment, while BlockFi and Celsius didn't immediately respond to Bloomberg's request for comment. One group that will likely be pleased by the SEC's scrutiny of Coinbase is congressional Democrats. Massachusetts Democrat Elizabeth Warren, a vocal critic of the financial industry, has repeatedly urged regulators to do more with the powers they have to police the crypto market. And Coinbase Global's chief executive officer blasted the Securities Exchange Commission for really sketchy behaviour after the company received that warning about regulators' plans to sue. In a Twitter thread, CEO Brian Armstrong said the SEC would be creating an unfair market if it tries to shut down its new lending product, which would allow consumers to earn interest on their crypto holdings. Coinbase, the US biggest cryptocurrency exchange, disclosed in a blog post that the SEC issued a Wells notice, meaning it may pursue enforcement action, and opened a formal investigation. We're being threatened with legal action before a single bit of actual guidance has been given to the industry, Armstrong wrote on Twitter. Regulation by litigation should be the last resort for the SEC, not the first. The issue centres on Coinbase's product called Lend, which the company has marketed as a high-yield alternative to traditional savings accounts that could earn an annual 4% yield. The product hasn't been launched yet, but Coinbase encouraged customers in June to sign up for pre-enrollment. The question of whether DeFi lending pools qualify as securities is shaping up as a key battleground for the SEC. Part of it turns on whether such setups meet the definition of investment contracts as established in the Supreme Court's 1946 Howey decision, which defines such contracts as the investment of money in a common enterprise with a reasonable expectation of profit to be derived from the efforts of others. In recent months, various state agencies have issued warnings about similar yield-earning accounts from BlockFi lending. Coinbase said it's been proactively engaging with the SEC on Lend for 6 months and expressed surprise over the possible enforcement action. The SEC has told us it wants to sue us over Lend. We have no idea why, wrote the company's chief legal officer, Paul Gruel. He added that the SEC has told Coinbase it considers Lend to involve a security but wouldn't say why or how they'd reach that conclusion. Armstrong echoed that sentiment. They're responding by telling us this lend feature is a security. Okay, seems strange. How can lending be a security? He wrote on Twitter. Coinbase said it's not planning to launch Lend until at least October as a result of the SEC's actions. So here we have another example in crypto land where effectively regulators are trying to get their head around a particular issue. Given the 4% being mooted as a return by Coinbase, you can understand why a number of people might be interested given the ultra-low interest rates and low term deposit rates at the moment. But the regulators need to catch up and quick because, of course, the fact of the matter is there are many people searching for yield. Some of the best yields out there are in crypto land, which is completely unregulated and is indeed the Wild West. No protections, just a gamble. So it'll be interesting to see how the SEC reacts and how wide they want to cast their net. We think it'll be wider than many in crypto land expect. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.